What's up, Investor Nation? Raspy Rye, your host of the iFC Market Update. We're coming back to you live. And of course, we have the special guest, the co host, Bryan Ziegenfuse, and Jack Davis from our capital markets team. What's going on, boys?
Doing well, doing well. I was at the Players Championship in Jacksonville last weekend, so that was a sweet experience, but ready to get back into it.
Love it, love it. There's a lot of buzz in Philadelphia. Got the NCAA championships with wrestling being hosted in Philadelphia here, which is pretty exciting. I can't believe the price of the tickets would blow your mind away. I was trying to get 2 tickets for my son Carter, but and then you've got the NCAA tournament with no Philadelphia team.
No Philadelphia. Yeah.
Yeah, we learned that yesterday. The wrestling, because did you see what's going on with your Penn State, right? So Penn State sweeps Iowa, and then Iowa's biggest booster then recruits the #1 wrestler in the country to come over for $5 million. Wild.
That is insane.
Unbelievable. All right, guys, well, let's jump into it. We have a lot of updates today. We have a really cool topic. We're gonna explain to you kind of how private credit came to be and why banks may be struggling to lend today. But before we do that, we're gonna jump into some economic updates. So we'll start on slide 4 here, boys, with the interest rates and the treasury yields between the 2 and the 10.
Yep. So, a lot is sort of unchanged from the last meeting. This sort of spread between the 10 and 2 year has stayed relatively constant, which has been, a sign that the market's sort of normalizing, as we've talked about in prior webinars. But I think what's interesting to jump into is the Fed had their meeting this week. Market knew that they weren't going to cut rates. They didn't cut rates. But they did announce moving the treasury cap from 25 billion to 5 billion. What that means is the treasury cap is like a mechanism they use for quantitative tightening or easing. So easing is they're buying treasuries, injecting liquidity into the market. Tightening is they're selling treasuries, sort of taking liquidity out of the market. And back, a year ago, they started this quantitative tightening where they were saying, we're going to start to let these treasuries on our balance sheet mature, and then not reinvest the proceeds. So not buy as many treasuries. So that's a tightening mechanism. Given sort of the uncertainty around tariffs, they're deciding that it makes sense to maybe slow down the tightening. So instead of not reinvesting 25 billion, now they're not going to reinvest 5 billion. So that actually is somewhat of a positive for the market. Means less liquidity is being taken out of the market. And so we saw equities rise on the news. Your risk assets rose, your rates dropped a little bit, but that was sort of the big thing. Next Fed meeting is going to be in May, 85% chance of no policy change, and then market pricing in 65% chance of potentially a 25 basis point cut at the June meeting. So that's sort of the recap I got on that meeting. Yeah.
The only thing I'd add is it looks like the Fed is still on track to have 2 cuts this year.
Yep.
And so that was, I think the market was is it 1? Is it 2? Are they uncertain? And so the fact that he came out and reaffirmed the fact that he's, kind of sticking with 2 cuts over the course of this year, whether that's 100, market, there's all the asterisks next to that. But that was, I think that's another kind of sign that the media picked up on, and then you also had a steepening event that had come from that. One of the things that I'd point out to everybody, like we talk about interest rates, we talk about your inability to predict interest rates. One of the things I'd look at on this chart here, and is if you took a line from like September to just past December to January, you've got that upward sloping I'm going to teach some, how to read some charts here. You've got this upward sloping line. And then if you took January back to March, you've now have a trend that's moving down. So you could draw a down arrow to that. And so if you think about, the markets are extremely efficient. The markets were picking up on accelerating inflation during, hindsight's 2020. So I could confidently, I think I can confidently say this now that the data's come through in the first quarter. And so the market was picking up on higher inflation prints coming, that was embedded in the market. And so you see that rise, and now you have, you have got, maybe less conservative markets thinking that in future the inflation is going to be a little bit muted there. And so again, that's why we always talk about, you can't predict the markets, because the market had a lot of good intel back in September, November, December. That was like, guys, inflation's picking up. And we saw those prints, which you're going to take us through, but we saw some of those prints in February.
Yeah, I thought it was pretty evident on his in his statement to the Ford's guidance that even though consumer sentiment was relatively down because it's hurting the consumer in their wallet, that he was pretty steadfast that the data shows inflation's kind of holding steady and kind of anchored, which is great news for the street. They love that certainty.
Yep.
Do we also, guys? I think it's also really important, and maybe we're going to touch on this in the next slide. JD and Bri, is the Fed's in a really good place, right? They can move up, they can move down, but they have a lot of flexibility where they're at, and they're kind of waiting to see how trade, immigration, fiscal policy, and kind of regulation reform, the net effects of that, right? So we're hearing a lot of buzz on tariffs, but he was pretty clear in his forward guidance that he hasn't seen that yet, although that may be coming, and they're going to kind of watch and see how that flows through the economy.
Yeah,
so that kind of leads us.
Yeah, I think, they, just like you said, they want to be able to. They want to be like, we talk about like being proactive, not reactive, but their job is really to probably be a little bit more reactive and wait to see how data actually pulls through. Obviously the Trump talking about tariffs, and people argue whether that's, going to be real or if that's like scare tactic stuff, negotiating power, that sort of thing. And rather than the Fed guess, they want to wait and see like sort of what actually happens and how it flows through the economy. I think they're gonna wait for actual data prints. So people talk about with the tariffs that tariffs are gonna slow growth and that they're gonna push inflation higher. And I think they're just gonna wait and see if he actually sticks to what he says he's gonna do, or if maybe it's just a negotiating tactic. So,
and what's great about the negotiating, about the negotiating will be deflationary,
right?
So that lead up is actually pushing. Unfortunately, it pushes uncertainty out into those other areas. So if you're a business owner and your business is relying upon shipping goods into the U.S., it's like you're not going to make big capital investments, or maybe you're not going to make as many capital investments. So that is a lot of the negotiating is going to be deflationary leading up to, maybe the actual event of charging.
Because it's just all like uncertainty, right?
Yeah.
So.
But that deflationary pressure tariffs could be offset by deregulation and potentially the tax breaks that are going to remain in effect. And so you could see a neutrality, how is kind of what
I think that's
what Powell was saying.
That's what exactly, because there's so many different levers, and it's how are they all gonna come to fruition with each other.
All right. So before we go to the next slide, we've talked a little bit about interest rate 2 and 10. What does that mean for DSCR pricing for our consumers and bridge pricing for our consumers, guys? For our clients.
Yeah, I think the stability, sort of that stability with the spread between the 2 and the 10, that's sort of given the market some confidence. And I think actually when the institutions have confidence sort of around treasuries I think there's like demand for that stuff. So we've seen on our DSCR loans pricing come in a little bit. I think probably, and I'm shooting from the hip a little bit, but the 30-year average mortgage rate is probably down from 7.5 a couple months ago to maybe 7.25 or something like that. But
Yeah, no, I think it's actually it's inside of 7 right now. But yeah, I think you've seen DSCR. Like I would expect pricing would have tightened, not materially, but Fed has its meeting. Traditionally, the markets or your desks that are pricing out mortgages, they're not going to do anything much leading up to the Fed meeting. They will. They'll let you've got the Fed has its meeting, and then they let a day kind of let the market digest, and then they'll start pricing loans kind of more towards what their expectations are of what credit spreads have done. And so the Fed's action resulted in definitely some tightening of credit spreads. You had a lead up to it where spreads were. I mean, you saw stocks. Stocks were getting pummeled. So your tech stocks were getting blown out. That was moving us in the opposite direction. Credit spreads were going wider because of that. And so but the Fed's movement, the Fed's meeting, it helped bring in some good steepening to the yield curve. And so, you're definitely tighter on your DSCR from about a month ago.
Yep.
The last time we met. And then in addition to that, on the bridge, construction loans, the bridge loans, you're seeing it isn't as price sensitive.
Right.
And so the market's going to take into account, that you're going to get 50 bips of price action probably this year at a pretty high probability. And so, you might see some of that trickle through the market.
Yeah.
We're getting a little tighter.
Everybody's getting a little tighter. A lot of liquidity in the market.
Yeah.
A lot of guys pushing. All right. So if we go to slide 5, 2 other kind of big drivers, macro drivers, inflation and unemployment, which were relatively steady. But boys, why don't you dive into that a little bit?
Yeah, so unemployment ticks a little bit higher in February against January. The January print was 4%. The February print's 4.1%. Same thing, non-farm payrolls. So that's adding, non-farm payrolls is measuring how many jobs are added to the economy. That came in lower than expected. So that's like a weakening of the labor market. And then CPI that we got recently came in lower than expected as well. At 2.8 month, the January print was 3%. Market thought Feb would come in at 2.9. It printed at 2.8. So that was positive. And we've talked about, back in January, like what's it going to take for rates to come down? And like two of the things that are big is like reining inflation in and maybe a weakening of the labor market. So this is actually really positive data. The only thing sort of offsetting it is the fear around Fed's now projecting higher inflation and higher unemployment, with maybe some of this Trump policy stuff. So, yeah.
Right. I think you'd add. Yeah. I thought it was interesting. Someone asked the question was the composition of the employment growth, which was government and government adjacent, which is healthcare, education. Right. Brian alluded to this, maybe 1 or 2 market updates. So, he kind of negated it, didn't really answer it, called jobs as jobs as jobs. But I think that'll be an interesting thing if we do see kind of unemployment tick up to 4.4, which is the projected kind of numbers.
Yeah, I think one of the things that it'll be interesting to see how so Jamie Dimon, it's if you take some of the figureheads out here, and media does broadcasts and you start to hear things over and over and over again, groupthink. And so if you take Jamie Dimon, he says his company, everybody's going to come back to work. And that started to set the tone for other companies. Yep. That might have been, maybe I'm going to be a little bit more flexible here. And you started to see this trickle down effect. With Doge, I'm curious to see if Doge and embracing kind of fiscal discipline, you definitely have some companies out there that maybe could tighten up their belts. And whether or not that kind of messaging where Doge, for what, if you like it or don't like it, whatever, but that concept is definitely trickling out of around being fiscally more disciplined into the private sector. That could be, that's not great news for the labor market, but something I think to pay attention to is maybe other companies, grab some of those sound bites and feel more confident.
Yeah, I thought what was interesting, I was listening to All In, and the Treasury Secretary was talking about if we did see layoffs in government and government adjacent, but we had deregulation, the private sector could then grow and potentially grab those jobs and bring them over. And so, it's going to be interesting to see how it plays out. But I thought it was an interesting nugget.
Yeah.
All right, should we move into banking consolidation? So I think this is a fascinating topic. Brian's been calling this since 6.5 years ago when we started this company, that banks are going to consolidate, and they were. And so we're going to talk about it today, and I think it'll really give you an understanding, if you're new to this market or if you're a seasoned investor, on kind of why the growth of private credit has happened in the industry. And then more importantly, we'll talk to you about why banks are relatively tight right now and why accessing liquidity from a bank can be challenging if you're a borrower, and why you may want to look at alternatives like private credit. So go ahead, Brian or JD.
So this is a great chart. We love this chart. It's in like all of our decks. But it just shows, the number of commercial banks and savings institutions has fallen by 60% over the last 30 years, which is pretty remarkable. And so we love this chart because it's like consolidation of banks. It's banks leaving the space. And why is that happening? It's the primary drivers are regulations and this high fixed cost structure, which we're gonna dive into. But
yeah, it's a tough chart to look at because it's just like the big guys have consolidated and consolidated and consolidated. So if you look at the assets, it's probably a little bit different than this, but the numbers are really what's going on here. And if you're like, we know, because our customers tell us all day long, all day, every day, how difficult it is to work with banks, whether they want deposits, they want to know, they want the kids to sign on the loans. It's a challenging process. And so, that filters into the regulation side of it. It also filters into when banks they start, they're almost forced to, because of how much fixed cost they have to introduce to into their organizations to meet regulatory requirements. That's reporting, that's technology controls. It just almost forces you, because when you have high fixed costs, you're just like a prime target to be acquired. It's like private equity 101, and it's so hard to combat that. It's so hard to combat that with how much fixed cost structure is really put into organizations. So prior to iFund Cities, I had the opportunity to watch a company that wasn't bank regulated move over to bank regulation. It was called Ally Bank. And so we took, during the heyday, or I shouldn't say the heyday, the great financial crisis.
the heyday.
Yeah, the great financial crisis. Christmas Eve, we got a whole bunch of money from the Treasury Department, and they're like, "You're now a bank, and here's what you got to go do." And
You love that.
What's that?
You love that regulation.
I remember that, like, my dad, who worked at Ally, that was like the most stressful night of his career, and I was like 12 years old, and I'm like, are we getting presents? Is Santa coming? Like,
yeah, it was legit on Christmas Eve. Like, it was actually Christmas Eve, late like 4 or 5. I don't know. It was late in the afternoon, I'll say.
Yeah.
And so that trickled into, you got the money, you're now a bank holding company, you're going to be regulated like the big boys, and if you were a consultant, you were going like this with your hands, like, come on, let's go, because of the amount of, whether it's technology infrastructure that you have to embrace and do, the technology infrastructure, the risk, stress testing, all of these things, which are good. Like, there's some balance of that's probably good and the right thing to do. There's a lot of good things that have come from that, but to set it up, to manage it, to control for it, holy cow. And so that's where the fixed cost comes from.
So I think there's a fixed cost component, but I also think the whipsaw regulation, it helped the larger banks and hurt the community and regional banks, because the capital requirements, which we're getting ready to get into, were the same despite the size. And so it really handicapped small community banks, which are then with their fixed costs and the handicap of regulations, were primed for the pickoff of M&A activity, which is what you saw. And so jumping into slide 8 here, guys, we could talk about the capital requirements. And this is a big component, I think, for investors that most don't understand, is that the risk is weighted with a capital charge at these banks. And so if they view it as a risky asset, there's a higher capital charge, which then reduces the net interest margin, which is how banks run their business. Look, one of the key metrics. And so that's really important. We're going to talk about that today, because that may be why you're not getting a CRE loan or a land A&D loan at a bank. So let's jump into that in slide 8, JD.
Yeah, so post-crisis, so December of 2010, there's this like Basel III Accord where sort of the world got together and is like, all right, we need increased regulation, supervision, risk management of banks, given what just happened over the last 3 years. And so what they decided when they came together is like, we should use this risk-weighted assets idea, which is like assigning a certain risk value to an asset. So your treasury, obviously your treasury is going to be a lot less risky than I'll say Bitcoin, for example. But they came together and they're like, let's use risk-weighted assets and then put in hard sort of capital controls. So depending on the makeup of your balance sheet, you need to hold capital relative to the risk of your balance sheet. And so what are risk-weighted assets? They're used to calculate this risk-adjusted capital ratio. And then you can stress test that capital ratio to sort of see how your bank would fare under different environments and different environments of certainly distress. But it's linking the minimum amount of capital you should hold relative to the risk profile of your balance sheet. And so the way they do it today is these risk coefficients are determined based on the credit ratings of different assets. So you think about, a AAA corporate bond is going to have a lower risk coefficient than a junk bond. And we'll dive into some specific examples, but that's sort of the framework. Yeah.
So our figure, if to translate it over to our business, in what our borrowers would expect to see, like if you did a land loan with us, we're going to say you need a little bit more capital in the deal than maybe a fix and flip loan. So think about loan to cost. It's how much capital is being placed against those types of assets. And so it's been, I think, it's definitely been helpful. There's certain assets that, I've been familiar with going through that transition. So like mortgage servicing rights were a big asset component of the banks. And so when they applied these risk coefficients, risk weightings against assets like that, which there's a lot of variability that goes with a mortgage servicing right. And so it can actually go down to zero. It can, and so there's, as if they prepay off the loans and such. And so it's very it's very interest rate driven. And so because of the fact that there's a high variable associated with that asset, requiring the banks in this framework to hold more capital against an asset like mortgage servicing rights, land loans, construction loans, those types of things is really how this framework is rolled out. And you just think of it as you've got a different, if you do you're doing land development, is going to be a different risk characteristic than, a single family, rental property.
So if you think about a bank and you're driving net interest margin, you're trying to grow your business, you're going to naturally stay away from those assets that have a higher weighted cost of capital than you are potentially some other alternatives.
And before Basel III and all this, it's, a bank can easily be like, because all I want is this net interest income margin. Like I want the higher interest rate. I want I want the risk in a way. But then when the whole world comes together and is like, well, if you want that risk, you got to hold X amount of capital on your balance sheet that crushes your net interest margin. Now they don't want to touch it. So.
By the way, that capital is retained earnings. So if you're an owner of that bank, you don't really want that in the tier one capital. So that balance, or you're charging more money to offset that weight, right? So as you're a consumer, you're going to feel that in your interest rate. So let's go to a couple. We got residential, commercial, and land development loans, because that's relevant to our market. So why don't we talk a little bit about that, with kind of traditional mortgages being residential, commercial being the loans that we originate in RTL, and then land obviously being the most risky. But Jack put together a great slide here showing some weights from the regs.
Yeah, so I think the and there, if you see these sort of two red boxes, so the way that these risk weights work is they're based on loan to value. And so when you're looking at the 60 to 80% loan to value, so on a residential mortgage, your risk weight is going to be, 40 to 40, your risk coefficient is going to be 40 to 45. So you've got to hold, if your exposure is 100 million to residential, you got to hold, 40 to 45 million of capital against that. And then on the commercial side, at the same leverage, so the same loan to value, if it's commercial property, you're holding 90 million against that. So you can imagine how that just immediately crushes. If you were at the same interest rate, then immediately you're crushed on the commercial side. And then land obviously even gets riskier, or is viewed as riskier. So you got to hold sometimes more capital than even your exposure is. You're going above 100%. So yeah, that's what I would say. Breaking outside. What do you?
Yeah, and this and
Great slide.
Yeah, and so the degree of this is it's interesting to see. So this is where the normalization of like a bank's capital, insurance money's capital, and so you start to see the convergence of that, where it's like, all right, now insurance companies want to play because they don't have they don't have free money deposits. And so you see that balancing out, and this allows insurance companies to participate, or other capital providers, securitizations, pensions, and other money managers, to partake in these areas that maybe are quote unquote higher risk, or for them to pick off some of the areas that banks just might throttle back on or reduce their exposure. And the like. And so I think there's a good, numbers way to show where our market is against where, we see the capital and the opportunities continue to show itself for private credit.
Yep.
And this is why if you're a borrower, they're asking you for deposits, because if you got to hold 90 million versus 100 million, they want some deposits to help offset that as they raise more capital. The other thing is, and Brian alluded to this, is insurance capital has a different weighted cost of capital for 1 to 4 unit resi that's much lighter than this on the regulatory side, and so that's why it's been a great natural fit to feed into private credit, i.e. RTL and DSCR that you guys are seeing today. All right, so we talked to you a lot about why banks potentially are having challenges, why they got consolidated. That leads us to kind of the private credit market and how it came to be. So if we go to slide 10.
Yeah, so
we're going to talk about how it came into portfolio. It's a mainstream asset now, man. Fully commoditized. We're in the mix here is my favorite line.
Yeah, so regional banks used to be pretty nimble and flexible with their balance sheets. And then Basel III happens, and they're maybe not set up to hold as much capital against their risk-weighted assets. So then naturally there's an incentive for those regional banks to move away from the riskier assets. So, maybe they were a big commercial real estate lender, and then, whole financial crisis happens. Now they got to hold 80, 90% capital against those assets, and they're smaller and just not set up to do that. And so naturally they're going to move away. And so we've seen just over time sort of the evolution of private markets, because somebody's got to come in and fill that void. And so that's sort of been the birth of private credit and where we, had our opportunity, I guess. Yeah,
I mean, I love talking to the friends that are out to dinner, friends that are financial advisors, and you drop, we run a private credit real estate fund, and they're like, the light bulbs actually clicked now. 4 years, 6, 7 years ago, it was like, what is that? And so you're seeing the RIA community have private credit vehicles pushed out through their financial advisor network. And so it's definitely, I definitely see it.
Yeah.
One of my favorite stories, we're sitting at Brian's family's beach house, and Jerry, his wife's father, is sitting there, and we're going, well, we run private credit real estate. And he's like, what is that? Fast forward to last year, he's like, Wow, you guys have grown the company really fast. That private credit's the real deal. we were dying. But it's a great fixed double digit fixed income return, adjacent to not taking market risk. And that's why you're seeing retail investors get excited about it. It's why the growth and the consolidation of banks has really opened up this great void for a lot of new capital to enter. And iFund cities and alike are the vehicles to work with consumers and understand our business and help provide that liquidity to the market. And that also leads to how banks didn't go away. They just transitioned to how they're lending to consumers through conduits like iFund cities. And the next slide is going to talk a lot about that, right? Because how they lend to a lender is a different way to capital than how they would lend to a consumer on commercial real estate. And that's actually the secret sauce behind how banks are actually participating in the private credit space at lower LTVs, at lower cost of capital, and still having exposure to real estate, but increasing that net interest margin and reducing quote unquote risk by shifting some of that off their balance sheet. So here's some partnerships I think that are really important that the boys put together. Jack, feel free to take it away, brother.
Yeah, I think the big banks, and going back to what I think you said earlier, that Basel III Accord, disproportionately hurt the regional banks against the larger banks, because the larger banks are like, all right, that's fine. If we have to adhere to this new risk-weighted assets protocol, that's fine. We'll just buy smaller like savings and lending institutions to juice our tier one assets, that are just deposits and not as risky. And then instead of doing the commercial real estate loan where the lender is JP Morgan, I'll just give a bunch of money to a private credit shop to then do those loans for me, because that risk coefficient for a loan to a private credit shop is lower than the risk coefficient if they were to go do the commercial real estate loan directly. And so we've seen all these sort of partnerships between big banks and sort of private credit or private companies, really over the last 2 years. Obviously, a bunch of big names here. Blue Owl, big leader in sort of the private credit space. Apollo, massive private equity, private credit shop. So yeah.
Yeah, these partnerships are going to continue. You're going to continue. You see, the banks still have a lot of capital to continue to deploy and push out, and so they're going to, they're going to utilize these channels to get the exposure, to get the net interest margin that they're looking for. And so it's it'll absolutely be a partnership. And you see a lot of folks that they come from the Goldman, the investment banking from Goldman, Citi, JP. They work their way out into these areas and they know how to underwrite the deals, put it together, structure it, and so I think you're gonna. This is probably earlier innings for this evolution, and it'll probably you'll see some of the larger regionals, like the next tier down. You got your top 4, top 5, and then you'll probably see some evolution down to the smaller. Shouldn't say smaller, but the next tier.
It's going to be interesting if we take the contrarian view, and I think this will be oncoming for us in the next couple months. Is if they do deregulate the banking industry, do community and regional banks come back and serve a purpose direct to consumer? Does that provide kind of additional liquidity to it, or does private equity, private credit continue to take kind of the liquidity to the next level? And so I think that's going to be something interesting to watch as they loosen credit potentially and deregulate banks, especially the smaller community banks.
Yeah.
All right, man. Let's go to Q&A. I know we bored you guys to death today with this topic, but it's super interesting. Well, at least I find it interesting. So let's see what kind of questions we get.
Yeah, we think it's important. I mean, part of the reason that we do this is the knowledge. You got to get the knowledge up. You got to invest in yourself, invest into this. This stuff is actually more important than you probably realize. Yep. As far as being a real, investor in real estate, which is, again, it's like a fixed income type of asset. So,
well, and we always see guys that are like, oh, I got a bank relationship. Well, that bank's going to have exposure limits. They're going to have spec limits. They're going to require deposits. They're going to have a higher weight. Like, that's our sales pitch, right? Like, and it's true. If you're a developer, you have to have maybe a bank for longer duration product. You need to have some alternative lenders. You probably need some private guys that could do some stuff on the fly. And I think that diversification of lending is key
Yeah.
for a real estate investor. That, that's something I've learned over my last 7 years starting this company with these boys is that is important. It's critically important.
Diversification.
Yeah. And going back to what you said, how it'll be interesting to see sort of what happens with the deregulation. I don't know. I feel like my opinion would be like, even if they do deregulate, now that these private credit, private equity companies have gotten a taste, like they're not going to like.
They're not going to.
I don't see a world where the regional banks find a way back in, really. Like a significant way back in. But
I would agree with that, but I do think you see compression on margin, right? From the private credit shop. And if you're a consumer, that's gonna be a great thing for you. If they deregulate the banks, they're back in business. You're gonna have better negotiating power between the private equity liquidity, the insurance money coming into the space. If they deregulate banks and start lending again, it's gonna be super interesting if you're a borrower to access credit, which has been pretty limited unless you have a great credit score and the ability to execute.
All right, we got a question. It's, if you had to quantify market share private credit gains from regional banks, what does that look like?
60%, right, Brian? All transactions are now coming through private credit from.
Yeah, that's probably a good number to look at. I mean, it's a big. I mean, it is. If you look at the chart, like if you look at that chart with the movement of where the investments are coming from, it's a big component, if not all, is coming from regional, even the top banks. And so what happens is, and I think I missed this point, is that JP Morgan's going to fund Main Street. They're going to fund the town center. They're going to fund, they're going to fund that Market Street in Philadelphia, that's town center. As you move out to different neighborhoods, the consolidation of as those banks consolidate really forces up, one, their lending, like it forces up the bottom. So they're not going to look at maybe they won't even look, like JP Morgan probably won't look at a $5 million project. They're really going to look towards like 50, 100, like really big. And so when that consolidation happens, it just takes that floor and moves it higher. That's a big deal in how this is trickling out to the private credit industry.
Next question. Do you guys have any sort of vehicle fund that you can JV with the builder to do the development and vertical?
So, yeah, we have the ability now to fund A, D, and C. There are some limits on the A and D side, but if it's smaller, it's a more of a liquid product. If it's bigger, then we may just do the A and D without the C. So I'd say if you have a deal, send it in. We'll give you that information below and we can underwrite it. But yes, we do have the ability to do A, D, and C today.
Do you see C and I flowing to private credit as well?
Yeah, so how I would answer that is it's already there. So that is actually a big component of private credit is they feed into CLOs. So there's a real estate component of private credit, but there's even a bigger business component, which is it could be receivables, it could be just business loans themselves, and so it's actually a huge component. I expect it. I would expect it to continue to grow. Yeah. Yep. Grow higher.
Yep. Can IFC be my equity partner on a new construction deal? Ryan?
Not unless it's really good and you milk some of the partners for some cash.
Yeah, right.
No, we unfortunately don't syndicate equity yet. Maybe some somewhere down the line, but for right now, we're going to be a senior debt shop and focus on our core business.
Mezz debt, question mark.
Yeah, I mean, I've been talking about this for 7 years. We'd love to get there. We went to A&D first. We will naturally be a trendsetter as we have since we started this business in new capital into the space. We obviously see there's a there's a need for mezz, but I would also say that stretch senior is so high today, it's almost the new equity. And if you can't go raise some LP capital at 95 loan to cost, 92 loan to cost, 90 loan to cost, 85 loan to cost, then you probably shouldn't be in this business. Not to be rude or direct, but I feel like that you got to be able to raise a little bit of capital. You got to have some skin in the game. So I think stretch seniors largely taken out mezz unless it's a bigger deal and a bigger cap structure. That's where you see mezz come in.
Yeah. I'll let you do this one. From your perspective, what are the differences between mezz and preferred equity, and how does IFC work within those scenarios as a senior construction lender in a deal? Do you see either or both growing in the current market?
Good question, Ricky. And so we look to see what the term, like, so there's a couple ways to look at this. What is the pref equity? What are the pref equity terms? What is their role in the deal? Are they, is it passive? Is it active? Do you have to go back to them and ask for permission to sell the properties, or if you had to sell them at a discount to keep the cash flow going? What are the roles of that operating agreement within the pref equity? Typically, mezz financing is super passive. Sometimes it could be a recorded instrument, its own deed of trust or mortgage to the property, and that typically is very passive. And it's like there isn't. You guys have an agreement in place. It's a little bit different than an equity provider. We work with we'll work with all these different. We work with all these different scenarios and understanding how your deal is structured. We actually, we pride ourselves in being able to look at those operating agreements, looking how you have it structured. We've got robust, analysts and underwriting to help you kind of model out the terms, model out the pro forma, model out what you're expecting. We do that ourselves as part of that senior debt, and we work with you. I think it's super important. We find it more and more important. Like, math doesn't lie, and it helps to level set, and everybody. It helps to really put a good baseline together for the transaction. And so, our teams would absolutely help work with you on your project.
It's a sponsor decision, right? It's a mathematical equation. How deep is the equity? Do you need that equity to go run pursuit on other pipeline deals, right? Like, there's a bunch of equations and why you'd look at mezz versus pref equity, for sure, in a stack. But to be honest, guys, to the community, the smaller deals, we don't see that. As we get into these land deals, these bigger deals that we're closing, we're seeing more of the mezz, preferred equity stack come into play.
Yeah, I don't know, and I don't have an opinion on the like, one of the questions was, where do you see it going in the current market? I don't know which one plays out better. I think it just depends on how you're raising capital. Is where
your ability to raise capital, right?
Yeah,
When we started, we had to take
deal.
mezz.
Yeah. All right.
Wrapping it up.
One more. Do you guys buy distressed debt from banks?
We'd like to.
I had to let him answer that first.
We'd like to. We don't. Buy non-preferred paper though.
I feel like I'm gonna have to ask some questions to you two later. I feel like there's tension around this question.
No, I do. You would love that.
Always new things. Where's the yield?
Yeah.
Yep.
All right, guys. Well, that concludes March. We look forward to seeing you guys back in April. We appreciate all the questions and the engagement, and we're excited to continue to bring you new topics. If there is a topic or a deal, please reach out to our team. We'd love to hear what you guys want to learn about in the real estate community. And if you're an active investor, again, we're happy to provide any insight that we can regarding your RTL, DSCR, or land deals. So we'll see you next time. Appreciate you, boys. Thank you.
Yeah, thank you. Thanks, Ricky.
Thanks, Ricky. Take care.